The next topic we need to cover is how to record compensation expense when employees are rewarded with restricted stock. Restricted stock just means that the employee's gonna own stock or they're gonna get awarded stock. However, they don't outright own the stock until the vesting period is over. So there's generally 3 dates with restricted stock. The first is the grant date when the restricted stock is actually awarded to the employees. After that, the employee generally has to meet certain vesting requirements. Sometimes that means they just need to work for 3, 4, or 5 years for that company in order to actually earn the stock and be able to sell it. So the vesting period is just a period where they're working for the company to actually outright own the shares, and then the vesting date is when they can do whatever they want with the shares. The accounting for restricted stock is very similar to that for stock options. Okay, so just like with stock options, we're first going to determine the market value or fair value of the stock as of the grant date. And then after the grant date, we're going to take that market value and we're just going to split it evenly over the service period, which for this class will just be your vesting period. And we're just going to recognize compensation expense for that split market value. So to see how this works, let's take a look at an example. January 1st, 2011, Bosco awards 100,000 shares of $2 par stock to certain key executives under its restricted stock award plan. The stock had a market value of $36 per share on the date of the award, and the stock sold for $38, $44, and $39 per share at the end of 2011, 2012, and 2013, respectively. Executives must continue in employment for 3 years or forfeit the stock. So as we had just mentioned, the first step is to determine the market value of the grant date. So we're awarding 100,000 shares, and it tells us the stock had a market value of $36 per share on the date of the award. So if we take the 100,000 shares, we multiply by the $36 per share, we get out to this market value of $3.6 million. So the market value is 3.6. Right, second step, since as of the grant date, we're actually awarding stock to the employees, we need to make a journal entry for this. Right, so since we're issuing stock, we're again going to record common stock in APIC as we learned last chapter. So common stock, again, just going to capture your par value. So in this case, the par value of the stock is $2. We have 100,000 shares, so 100,000 times 2 gets us to 200,000. The issue price of these common stock is going to be essentially the market value. So as we learned, APIC captures the excess of the issue price over par. So the difference between 3.6 million and 200,000 is the other 3.4 million. The debit in this case is going to be to an account called unearned compensation, which is just an equity account, and we're going to make a debit here for the full $3.6 million of stock that's going to be paid out to the employees at a later date. Okay, so now the second step after the grant date is we're going to split this market value over the vesting period, and we're going to recognize it as compensation expense. So our vesting period in this case is from 2011 to 2013, or 3 years. So if we evenly split this 3.6 million over 3 years, that means over each year we're going to recognize $1.2 million of compensation expense related to this restricted stock. So at the end of 2011, 2012, and 2013, we would debit compensation expense for 1.2 million. And our credit here, since we've recognized unearned compensation previously, we're going to decrease unearned compensation with a credit. So this slide just covers what we just went over. So we'll just move on to the next slide. So this slide covers how we treat forfeitures of restricted stock. So if the employees don't work for us for the whole vesting period or they don't meet the vesting requirements, then they forfeit the rights to the restricted stock. So let's just assume the key executives of Bosco leave the firm in early 2013 before compensation expense has been recorded. The executives thus forfeit their rights to the stock. Bosco makes the following entry to reverse any compensation expense already recorded. So since the restricted stock is being forfeited, the company just needs to reverse the effects of the past transactions that we made associated with this restricted stock. So if we kind of take a look over here, we made this journal entry on the grant date. And then since in this case they're forfeiting the stock in early 2013, that means at the end of 2011, we made this journal entry, and we would have just made the same journal entry at the end of 2012. All right, so altogether, we've recognized common stock of 200,000 and APIC of 3.4 million with a credit. So we're just going to reverse that. We're going to debit common stock for 200,000. We're going to debit APIC for 3.4 million. Right, the other two accounts we're dealing with then is unearned compensation and compensation expense. Since at the end of 2011 and 2012, we would have made a debit to compensation expense for 1.2 million. In total, that means we made debits to compensation expense for 2.4 million. So we're just going to reverse that now. So we're going to credit compensation expense for 2.4. And then finally for unearned compensation, we started with a balance of 3.6 million. We decreased it twice at the end of 2011 and 2012 by 1.2 million. So if we're making a T account to keep track of it, we would just have a $1.2 million balance on unearned compensation. So we'll just make a credit for that amount to remove that also from our books. There is an alternative approach to record the journal entries for restricted stock. This approach isn't covered in your textbook, which is known as the CASO textbook, because that's the first author. I'm just going to go over a brief overview of this. I'm not going to require you to know this for exam, but I just wanted to make you all aware of this in case you wanted to take the CPA exam. So under this method, on the grant date, you're not going to record anything. Rather, you're just going to record compensation expense at the end of each fiscal year. When the restricted stock fully vests, we're then just going to remove the PIC restricted stock account from our books, and we're going to recognize common stock instead. So the last thing we need to go over related to stock-based compensation is non-compensatory plans. So a non-compensatory plan just means that employees have a share purchase plan, but pretty much this purchase plan just allows the employee to buy stock, but they're not getting much else. So if they're not getting much else, then it's just they're not actually getting rewarded for anything. So we're not going to record compensation expense related to it. In the second half of Chapter 16, we're going to learn about earnings per share, or EPS. You've probably heard of EPS as it's the most closely watched financial ratio in the investment community. EPS at a basic level just consists of two components. Right? You have earnings in the numerator and you have shares down in the denominator. Usually the earnings number we focus on is net income. And then in the denominator, you focus on common stock outstanding. And so earnings per share is designed to tell us that for each share of common stock, how much profit are we generating on behalf of our shareholders? Since we're trying to focus on the profit generated on behalf of common shareholders, that means that if the company pays preferred dividends, those profits are no longer available to common stockholders. So out of net income, we're also going to subtract out preferred dividends. This next slide just gives you an overview of what we're going to cover in this chapter. So this earnings per share formula here is for basic EPS. Again, is telling us how much profit is available for each share of common stock that the shareholders have. As you've learned in Accounting 301A or Intermediate 1, all companies have to report basic EPS at the bottom of the income statement. When a company has any convertible securities, as we learned about in the first half of this chapter, like convertible debt, convertible stock, or stock options, in that case, they have what is known as a complex capital structure. If a company has a complex capital structure, then in that case, they have to report what's known as diluted EPS. Diluted EPS is kind of like a worst case scenario. It just proposes that if all of these convertible securities were converted to common stock, then what would our EPS be? So diluted EPS is just EPS if all convertible securities were converted. So we'll start with basic EPS. We'll learn the basics of this because we'll use this as a basis to calculate diluted EPS. So we've already talked a bit about basic EPS. Again, basic EPS just tells us the amount of profit that's available for each share of common stock. So we said the earnings number we'll use is net income. And then we're subtracting out preferred dividends because if we pay dividends to our preferred shareholders, that profit's not going to be available to our common stockholders. In the denominator, we have common stock outstanding. We can't just use common stock outstanding because usually the amount of stock is going to change throughout the year. So instead, to account for different amounts of common stock outstanding through the year, we'll use the weighted average of common stock outstanding. All that means is we're going to weight the amount of common stock by the fraction of the year that these amounts are outstanding. To see what I mean by that, we can just use an example. So let's say Mesa Incorporated started 2001 with 100,000 shares outstanding, but issued 40,000 shares on April 1st. Mesa also has 40,000 shares of $5 par preferred non-convertible stock paying a 5% dividend. Mesa's net income for 2001 was $800,000. So the numerator of EPS tends to be very simple to calculate. Net income will usually be given to you. So in this case, net income is $800,000. So we'll just plug that in. Dividends are typically stated as a percentage of par or on a per share basis. So in this case, our preferred dividends are 5%. So to calculate this, we'll just take 5% of the par value and we'll multiply that by the number of preferred stock outstanding. So our preferred dividends in this case, we have 40,000 shares. The par value is $5. And then we're paying 5% of par in dividends, so we'll multiply by 5%. That'll get us out to $10,000 of preferred dividends. So we'll just plug that in over preferred dividends. So we have 10,000. The final part we need to calculate is weighted average common stock outstanding. Again, we're just going to take the number of common stock on any date and we're going to weight it by the fraction of the year it's outstanding. So I'll have shares and off to the right I'll have weight. Okay, so in this example, we start 2001 with 100,000 shares outstanding. So these 100,000 shares are going to be outstanding for the whole year. So they're going to receive a weight of 12 out of 12 months. The company then issues 40,000 shares on April 1st. So these 40,000 shares, we just need to count out the number of months they're going to be outstanding until December 31st. So if we count it out from April 1st to December 31st, should hopefully get to 9 out of 12 months. All right, so we're just going to multiply the number of shares by the weight for each one. And then at the end, we're just going to sum it all together. And that'll get us to 130, and that's our weighted average common stock outstanding. There are two different ways to calculate weighted average shares outstanding. In this method, we're kind of calculating the weighted average based on the incremental number of shares issued throughout the year. You could also do this in a way where you're just taking your total shares at any point in time, and then you're weighting that throughout the year. So to see what I mean by that, we can take the same kind of example, and we're just going to change the weights here. So the company has 100,000 shares from January 1st out until April 1st, at the point in which it issues 40,000 more shares. So it has 100,000 shares for 3 months out of the 12 months of the year. So it receives a weight of 3 over 12. On April 1st through December 31st, it has 140,000 shares because it issued 40,000 more shares on April 1st. So it has 140,000 shares for 9 out of 12 months of the year. So in this case then, if we multiply through by the weights, and then we add them together, we're going to get out to the same answer. Okay, in some cases, doing it the way we covered first might make more sense to you. In some cases, doing it the second method might make more sense to you. If it doesn't matter which method you're using, I would recommend using the first method, because this will make things a little bit easier when we go to cover diluted EPS. But both methods going to get you to the same place. Both methods obviously are acceptable, so use whichever one makes the most sense to you. Let's go through a couple more examples to cover different scenarios. So in the second example, we have pretty much the same thing going on as in the first example, but now the company is going to repurchase 20,000 shares on July 1st. So the company is making a stock repurchase. As we learned in chapter 15, when a company buys back its stock, it's known as treasury stock. And this reduces the amount of common stock outstanding. So I'm just going to get rid of this so we don't get confused or you don't get lost in all this stuff on here. I'm going to remove this as well. Okay, so in this case, all right, we still have this $100,000 or 100,000 shares from the beginning of the period, so it still receives the weight of 12 out of 12. The 40,000 shares is still issued on April 1st, so it's still going to receive a weight of 9 out of 12 from April out to the end of the year. In this case, however, the company is repurchasing 20,000 shares on July 1st. Since it's a stock repurchase and it reduces the amount of common stock outstanding, we'll put in negative 20,000 for the shares. These 20,000 shares were repurchased on July 1st. So from July 1st out until the end of the year is half a year. So it'll receive a weight of 1/2 or 6 out of 12 months. Okay, we can multiply through the 20,000 by the 1/2. We'll get out to negative 10,000. And then at the end, if we want to sum everything up, we'll get out to our weighted average stock outstanding. Again, we could also do this using the second method I covered, where you're multiplying the total shares at any point in time by the weight. So if we wanted to do it that way, we can again do that. So again, this 100,000 shares, this goes from April 1st out to, January 1st out until April 1st. Right, so that receives a weight of 3 out of 12, or 1/4, so 25,000. On April 1st, another 40,000 shares are issued, and so we'd have 140,000 shares. We'd have this 140,000 shares from April 1st out until July 1st, when the company repurchases 20,000 shares. So you'd have April, May, and June, or 3 out of 12 months. Again, if we took 1/4 of 140, or 3/12 of it, you get out to 35,000. And then on July 1st, the company repurchases 20,000 shares. So at that point, we would have 120,000 shares of common stock outstanding. And we'd have this from July 1st out until the end of the year. So that would be 6 months out of 12. So if we take 1/2 of that, you get out to 60,000. And then again, sum up everything, and again, you'll get out to 120,000. Calculations for weighted average shares outstanding get a little bit more complicated when there's a stock dividend or a stock split. So we'll cover that in the next example. So when a stock split or stock dividend occurs, no new capital is going to be received by the company, and the proportional ownership of each stockholder is going to stay exactly the same. So when a stock split or stock dividend occurs, we're going to have to adjust the share amounts prior to the split to correspond to the number of shares after the split. So in other words, we just need to put everything on an apples to apples basis. So in this example, Mesa has a 2-for-1 split on May 1st. All that means is any shares prior to May 1st, we need to multiply by 2, since each share is split into 2. Right. Anything that's after May 1st, we don't have to adjust because those shares are already on the new basis, so no adjustments necessary. So in this example, I'm just going to get rid of this bottom part so it doesn't confuse anyone. Right, let's put in the dates so this makes sense. Right, so the stock split 2-for-1 occurs on May 1st. So anything prior to May 1st, we need to just adjust by a factor of 2. So these 100,000 shares on January 1st, because it occurs prior to May 1st, these 100 shares have now been split into 200,000 shares. Same thing for April 1st. These 40,000 shares that were issued, we would have split each of these shares into 2. So we now can multiply by 2. So we end up with 60,000 shares. And then for the shares we purchased on July 1st, these shares were repurchased after the stock split on May 1st. So we don't have to adjust these at all, and we'll just leave it as it is. So in this case, we would end up with 250 shares outstanding. In the case that you have something like a stock dividend, so let's just say there's a 50% stock dividend. In this case, you're going to do a similar process, However, stock dividend or 50% stock dividend now means there's 1.5 times more stock than before. So now your adjustment would just be 1.5 for any date before the stock dividend. Now that we know how to calculate basic EPS, we can use it as a basis for calculating diluted EPS. So just as a quick refresher, basic EPS is equal to net income minus preferred dividends. And then we divide all of that by our weighted average common shares outstanding. When a company has any type of dilutive securities, it'll generally have to report diluted EPS. The dilutive securities we'll go over will be convertible debt, convertible preferred stock, and stock options. So to calculate diluted EPS, we're going to start again with our basic EPS calculation. Right, and then we'll adjust both the numerator and the denominator for the effects of the conversion or exercise. So for all three of these dilutive securities here, when they're converted or they're exercised, it's going to end up increasing the number of common stock outstanding. So we're going to add additional shares to the denominator for diluted EPS. When we calculate diluted EPS, we're going to calculate it on a worst case scenario basis. All that means is if we have any dilutive securities outstanding at the beginning of the year, we're going to assume that they are converted or exercised at the beginning of the year. In the case that a company issues dilutive securities in the middle of the year, they're going to be consumed, converted, or exercised from the point of issuance. Beyond affecting the denominator, each of these dilutive securities, or each of these will generally affect the numerator as well. So for example, with convertible debt, if a company converts its debt, it's no longer going to have to pay interest expense on its debt. And so since interest expense affects net income, we would add that interest expense back in. The type of adjustment we'll make for each of these dilutive securities will depend on the securities, which we'll talk more in detail about later. So we'll also make adjustments to the numerator. Since these dilutive securities are going to affect both the numerator and the denominator, it's not always the case that diluted EPS will be less than basic EPS. In the cases that EPS doesn't decrease as a result of dilutive securities, in that case, we say the security is anti-dilutive. So if EPS doesn't decrease as anti-dilutive, in that case, we are not going to report the effect of that security on EPS. If, however, diluted EPS decreases relative to basic EPS as a result of the dilutive security, so if your diluted EPS decreases, then it is dilutive, and then we'll include it. All right, so again, to calculate diluted EPS, we'll start with basic EPS, and you just make adjustments to the numerator and denominator to capture the effects.